JP Morgan, Chase CEO Jamie Dimon, and other financial executives will give you their predictions for the U.S. economy over the next few months, including rate cuts. I will also be providing you with a wealth of current information about the U.S. economy and things I am keeping an eye on in real time. Here is all of that data and material. But I also discuss this a lot in my live chats. You will have a clear idea of the state of the economy today and its future direction after watching this video. Come on. The economy is declining, in my opinion. I'm not sure whether that is a sign of a recession or simply a weakening. And that sort of validates what we already believed. And I am aware. It's a significant revision. Speaking of which, we're returning to the challenge of forecasting the current health of the economy. What's happening with the customer at the moment is one of the queries individuals have. They continue to spend money. Depending on their financial level, it varies slightly. They are still employed. Customers therefore often respond to that. Thus, the customers become weaker. Trade declines. I am aware that corporate private is still open. The economy is currently influenced by a wide range of issues. Determining the meaning of it all is difficult. I've always been rather doubtful of most forecasts for that reason, you know. We should thus wait, and there is a lot of stimulus available. We are unsure about what the federal government should do. They will most likely lower rates, but I don't believe it will be a result of the state of the economy. We shall see. Next week, they're going to cut? Indeed, they will cut. They should cut 50, in my opinion. They will most likely cut 25, will vary. You know, the CPI data that comes out on Thursday or tomorrow will be intriguing. Listen. I believe they should reach 50, but I also believe they will reach 25 before we begin to decrease the rate. Nevertheless, this kind of income can still be obtained by constructing a portfolio. You can still remain in the front to the belly of the yield curve, by the way. Obtain that yield. Since your actual rates are now somewhat intriguing, we have been extending out a little. Acquire the fascinating items. Real rates at this time are actually acceptable if inflation is hovering around 3%. The curve is now out. Your coworker, previous classmate, fellow student, Jamie Dimon, a former coworker, claims that the economy is deteriorating. Do you think the economy is becoming worse? First of all, I believe it's complex, and that sound bites are really hard to decontextualize. And I divide it into two groups. The first is based on our own data. The second is what our own data shows more generally. It's remarkably stable. We see, for example, that consumer spending across nearly all wealth levels remains at the same annual rate. As you guys discussed this morning, in the past 6 months, consumer credit has been at its best. Actually, it's most likely trending slightly better. Businesses are doing incredibly well. We search for any indications of change, but you fail to notice it. That being said, there is a significant disparity between customers with higher and lower incomes that persists and is a genuine problem. And if you just look at the total number of jobs, it's clear that jobs are being created. Indeed, compared to what you could have imagined, things feel really fantastic now. However, it's not the same for all wealth levels. Additionally, there are most likely more drawbacks than advantages. You may see both high and low-end consumer spending. Okay, let's simply go on. I realize the clip was a little bit sluggish there. I'm sorry. X was experiencing some technical issues. I also wanted to quickly share you something here. One of the most significant economic issues of the day, in my opinion, is This is Scott Bessent, the U.S. Treasurer, sort of outlining his thoughts on the situation. Although this was from a month or two ago, it still provides you with some background information about where I'm taking this video and what I'm going to demonstrate. The upcoming years. Is it feasible for the two biggest economies in the world to rebalance together, or will they continue to separate? Senator? President Trump wants to reduce the trade imbalance and rebalance the U.S. economy toward increased manufacturing. The Chinese are still expanding their industrial capabilities. They currently hold 30% of the world's capacity, which is a significant increase since 2020. They enhance capacity under the COVID-19 pandemic. They are currently seeing a significant decline in real estate. It might be referred to as a crisis. Their consumer spending is quite low. They must therefore correct their domestic imbalances and rebalance to increase consumer spending. But they cannot do so at the expense of workers around the globe. We may thus work together if they are prepared to be good partners and approach a discussion where the U.S. restores manufacturing, precision manufacturing, and high-paying employment, and the Chinese are prepared to open their economy to American goods. All right. So the goal of the trade war and tariffs is to restore manufacturing employment in the U.S., correct? Well-paying manufacturing positions. So let's examine the economy's general health and data. And I actually want to show you some things about manufacturing and what it means for the entire American labor market, as well as if it makes sense to do what we're doing today. Thus, this is a summary of the U.S. economy. Due to a number of causes, including higher tariffs, stricter monetary policy, and difficulties in international commerce, the economy has slowed significantly in 2025. After falling by 0.05 negative in the first quarter, real GDP increased by 3.3% annually in the second quarter. However, the overall growth for the first half of the year was only 1.4%, which is roughly half of the 2.8% observed in 2024. Forecasts predict that fiscal stimulus measures will result in sub-1% growth in the third quarter and a slight improvement in the fourth. The One Great Bill Act has started to have an active impact, revenue from tariffs at the moment. With a record $31.4 billion collected in August alone, tariff collections in 2025 total $183.6 billion. The tariff is paid by whom? American importers. The tariffs are paid directly by U.S. companies. The majority of research indicates that U.S. businesses bear more than half of the tariff burden. According to a recent study I came across, U.S. consumers and businesses pay 86% of tariffs. According to recent projections, U.S. companies will bear just over half of the tariff expenses in 2025. And the consumer share price will surpass 67% in the upcoming months. Actually, it's a lot higher. Effect on farmers and businesses. U.S. farmers' exports to China fell 39% year over year, with soybean export losses expected to surpass 25 million metric tons and corn exports to China falling by up to 90%. Actually, corn and soybeans at the moment. We sent China between $12 and $14 billion last year. Nothing this year. For farmers in the middle of the country, that is a huge hit. In the first half of 2025, the farm trade deficit was $28.6 billion. The unemployment rate is 4.3%. August 2020 and 25 saw the biggest increase since October 2021. Only 22,000 jobs were generated in August, significantly less than anticipations. From April 2024 to March 2025, the U.S. economy added 911,000 fewer jobs, according to the annual revision. This is also fascinating because I had mentioned multiple times in my live streams that the economy was already slowing down under Biden when he was leaving office. Additionally, the initiatives that Trump implemented to try to rebalance American manufacturing have actually slowed down. AI is also contributing to the acceleration of job loss in this area. People probably don't aware that in the coming years, robotics, artificial intelligence, and AI will replace 20 to 25% of all jobs. Therefore, if you now hold a position where you believe AI may replace you, you may wish to brush up on your knowledge of AI so that your abilities will surpass those of your coworkers. Because if they see that you and your friend have the same resume, but that you are skilled in artificial intelligence, most likely they will pay you more and keep you. And regrettably, the problem here is that, as you can see, a large portion of the